Hello and welcome to another episode of Transforming Business with me, Marvin Schneider, where I talk about transforming the global business and investment communities to create sustainable wealth on an ongoing basis. And that's an important term, ongoing basis, in ways that enhance the well-being of the individual, the wider community, and the environment. And the last aspect of that, enhancing the well-being of the individual, wider community, and the environment, is one of the core tenets of the shift in business paradigm that is currently occurring, which means that business is, being in business is an opportunity to be of service to society, not an opportunity to exploit it in ways that, make a lot of money almost regardless of how that money is made and the impact that the corporations have on the individual, the wider community, and the environment. And so increasingly, there will be a recognition that in the long run, the only way to create wealth in any sustainable or ongoing basis is by enhancing societal well-being. And I've made that sort of comment and proposition a number of times. I'd encourage you to jump onto YouTube, subscribe to my YouTube channel called Valuation Insights. Just search for Valuation Insights on YouTube. Subscribe to the channel. There is a podcast series playlist called Transforming Business, and you can follow along with me right from the beginning. I think this is about episode 7, 8, or 9. I haven't sort of kept count of all of these things. So for a number of episodes recently, I've been signaling that I want to do a episode dedicated to the topic of executive reward, because even now, but certainly 2 to 3 years ago, when I was heavily involved in this area of the overall corporate management process, I got to be honest, it was a mess. And I will talk a little bit about what previous executive reward practice was predicated on, some of the principles. But my proposition is that those principles are fundamentally flawed and wrong. And to the extent that reward consultants are advising clients to adopt these very old paradigm structures, I think what's going to occur and what will be increasingly realized is that very quickly boards will realize that the fundamental premise and tenet of those structures are flawed, not fit for purpose, and are driving executives either implicitly or explicitly into a set of outcomes which are leading to very poor outcomes for the corporation as a whole, and certainly stakeholders, other stakeholders, and leading to very challenging reward outcomes, which a lot of people and the broader community are rightly, concerned about, because when through random actions of the capital markets, when CEOs and executives, and particularly in this podcast episode, we'll focus primarily on the CEO, but the topic can equally be applied to other of the top management team. When they are getting reward outcomes which are inconsistent with community expectations, and also inconsistent with the actual performance of the company, then we know that there is something fundamentally wrong. And so I'm going to offer you in this podcast episode a very simple solution to executive reward, which is fit for purpose in the new paradigm of creating wealth on an ongoing basis in ways that enhance the well-being of the individual, the wider community, and the environment. So we'll get to the reward topic further in a second, but let me quickly share a couple of screens, share screens with you, a couple of slides. And I just want to quickly recap a little bit about providing the context for the reward discussion. So, okay. So over the last couple of Transforming Business podcast episodes, I've introduced the listener to a number of concepts, but one of them is the Cause OCI assessment matrix, which is a framework for assessing where companies sit at the moment or at any point in time on two dimensions. The first dimension, which I call the cause rating, is assessing the extent to which the company is operating on principles consistent with ongoing wealth creation in ways that enhance the well-being of the individual, the wider community, and the environment. And so the elements to that rating system are a reflection of the extent to which the company has a purpose grounded in a noble intent to be of service to society, and the extent to which their products and services and the way that they are produced and distributed, and therefore the economic outcomes that are achieved from that, are consistent with being of service to society and creating wealth as a result of doing that. So I won't go into too much more detail about the elements of the framework, but the horizontal end of the matrix, which I call the OCI rating, which is an acronym for Organizational Capability Index, is a reflection of the characteristics of the company in terms of the way that they operate in relation to things like board governance, strategic management, operational effectiveness, culture and leadership, and the extent to which all of that harnesses and institutionalizes an innovation capability, which ultimately is the fundamental driver of ongoing wealth creation. Let me just say that again. The short answer to how do I create wealth on an ongoing basis? The short answer to that question is innovation. It is a human endeavor. And so now I've previously made the point that without having gone through assessing, every company on the planet, but having been in and around consulting and observing large corporations, my hypothesis and my contention is that the large majority of companies, probably in excess of 90%, are going to be positioned somewhere in the bottom half of this matrix, which basically reflects a subpar score on the very important cause rating dimension, the vertical dimension. And my view is that of those, a very large proportion will be dominated in the bottom left-hand quadrant. So not only do they have a subpar cause rating, in other words, they're operating on principles heavily dominated in the old paradigm, and those principles are inconsistent with the kinds of principles that will be required in the long term to be a top performer. So not only are they operating subpar on the cause principles, they're also operating subpar on the characteristics required for excellence in terms of corporate capabilities, governance, strategic management, and so on, and in particular, the innovation capability. So, and that's a problem. It's a problem for institutional shareholders. It's a problem for society at large. And so a large proportion of corporates at the moment are really not serving society and humanity in the way that they really need to, ought to, and must, as we shift into the new paradigm, which is centered on higher consciousness in business, doing the right thing, creating wealth by doing the right thing, not making lots of short-term profit in any way available. So you really don't, as a corporate, as a board and an executive team, you really don't want to be in the bottom left-hand quadrant of this matrix. And the issue is that at this point in time, a very large proportion of corporates around the world are probably positioned somewhere in the bottom left-hand quadrant of this matrix. And so that ought to create a little bit of a burning platform pain issue, because it is not a sustainable place to be. In the medium term, I'm going to say the medium term, companies that are either unwilling or unable to shift from the bottom left towards the top right will not survive. Okay, there's going to be a bunch of companies that are going to be positioned in the bottom right-hand end of the quadrant. And a lot of the digital monopolies in the US, they're very successful companies financially and on the stock market. But the issue that those companies face is that very quickly, and there'll be this watershed moment, but very quickly, their business model will be abandoned by customers, consumers, the wider community, regulators, because they are operating, their business model is fundamentally egregious to the expectations of customers, consumers, the broader community, and regulators will step in and either break those businesses up or put in place regulations that will make that business model untenable. Not so equally, but in other ways, you don't want to be positioned for too long in the top left, right? So these are companies that are operating on really noble principles, but they don't have the foundations of the internal organizational capabilities to be successful in the long run. And so, we might describe these companies as being well-meaning, but in the long run, they may not survive because they don't have the systematic, structured approach to ongoing wealth creation. So in a lot of ways, about the only place where you want to be positioned in the long run is in the top right of this matrix. And that's why I find this matrix a very useful both assessment framework, so that we can objectively assess where companies are at various points in time, which will be very, very important for the impact investing and institutional investment community. And I'm going to talk about that in a later episode. So it's an objective assessment framework and providing data points. And it's also a very useful framework to communicate to boards and executives in concepts that kind of make sense. So here's the thing. For companies that are positioned in the bottom left or anywhere other than the top right, the imperative is to transform. And that's why I call this whole podcast series Transforming Business, because it is an imperative that exists within, I would say, certainly greater than 90% of the large corporates around the world is the imperative to transform. And the general proposition is that the transformation required is extensive, and it may well take 3, 5, 7 years to complete the transformation process in a number of moves, both in the vertical direction along improving outcomes on the cause rating scale, and then in the horizontal direction, improving outcomes on the OCI rating scale. And there might be a series of moves over 5 to 7 years until you get to where you need to be. And then you need to keep working to stay there so that you don't regress backwards. So that's the transformation scale. Now, in moving towards the vertical direction, there are a number of things that boards and executives really need to be addressing, and acting on immediately. And I've talked about these before, but let's just quickly recap. The first is that they need to fundamentally rethink their purpose, and that purpose needs to be grounded in a noble intent to be of service to society. And so that fundamentally everything that the business does, the corporate does, is done in a way that enhances the well-being of the individual, the wider community, and the environment. So that purpose needs to be dominated in a noble intent to be of service to society. The second thing is that boards and executives need to recognize which aspects of their existing business model are no longer fit for purpose. Now, the uncomfortable truth and reality is that in a large number of corporates, there will be a lot of things about the existing business model which are no longer fit for purpose. And that may confound the board and the executives because they have a legacy business which is dominated in old paradigm regressive concepts which don't serve them anymore and which won't serve them in the future. The next thing that they need to do is they need to envisage and then, of course, implement a bold new participation strategy, or let's call it a business model. And that business model needs to start with the kinds of products and services that are put in the market and the extent to which they enhance societal well-being, and then build a delivery system, which is production and distribution system of those products and services that, again, enhance the well-being of the individual, the wider community, and the environment. So you need to envisage and then implement this bold new strategy. Of course, because so much of the existing business model is predicated in old paradigm structures, there will be a need to transition away from the old paradigm business model. And that is going to be moderately painful for a large number of companies, because the practical reality is that, in the universe of companies out there, there will be trillions and trillions of dollars currently invested in assets, infrastructure, production and distribution systems, which will very quickly become stranded assets. They will be, and which is a problem because you've now got an asset on your balance sheet which isn't productive anymore, and at worst, it'll represent a liability to the company. So we do need to transition away from those old paradigm business models, and fossil fuel electric generation is one of those things that those companies that are heavily invested in those assets and infrastructure, they do need to deal with the transitioning away from that. And of course, prior to the transitioning away from it, they're going to need to invest trillions of dollars, across the corporate universe, in putting in place business models and structures and whatever that are fit for purpose. So we kind of talked about a lot of these other things, but and then of course they need to put in place the internal systems, processes, cultures, leadership capability for long-term, ongoing, sustainable wealth creation. That's really reflecting the horizontal dimension of the previous matrix, the OCI matrix. Okay, so all of these really big picture transformation things are really heading you predominantly in the vertical dimension in the first couple of elements of this, and then in the horizontal dimension. And so the positioning in the vertical dimension will be heavily, or needs to be heavily, dominated in a set of core principles consistent with cause type things, which is wealth creation on an ongoing basis in ways that enhance the well-being of the individual, wider community, and the environment. So I won't go through these 6 core principles again. If you're interested in more of the recap, go back a couple of episodes where I talk about these kinds of things. But one of the interesting and important principles is the concept that more is not always better, that there is an optimal level of financial performance and there is an optimal level of capital market performance, shareholder wealth creation outcomes, beyond which, if you seek to drive performance beyond these stable, sustainable, optimal levels, it has a tendency to lead into and perpetuate practices and outcomes which will, which go against the intention and direction that you're trying to get to. So this is going to be really important in the executive reward conversation, which we're going to come to in a second. The last slide before we do get into that conversation is that I have previously shared with the listener a systematic and a structured approach to large-scale business transformation and then ongoing wealth creation. And again, I won't be going into this in detail. Go back a couple of podcast episodes. But my point here is that executive reward has a role to play in the value realization, the strategic management processes. It does have a role to play, but unfortunately, a lot of executive reward practices are put in place in a vacuum of understanding what wealth creation is, how to drive it, and how to do it on an ongoing basis, and particularly how to do all of that in the new business paradigm, which is enhancing societal well-being. So let me stop sharing screens for a second and just come back to camera, and let's talk about executive reward or current executive reward practices. All right, there's a lot to say about this, and we'll try and unpack it fairly systematically. All right. Current executive reward practice is heavily dominated in a couple of principles, one of which is that because of the separation between owners and managers, that there is an idea that managers need to be incented and rewarded to create positive shareholder value outcomes. And so this idea became quite prevalent, particularly in the US, and those reward structures have been exported quite extensively across a large part of the Western economies, particularly in Australia, the UK. I'm not sure so much in Europe. I haven't had that much experience in the European context. So I don't know the extent to which European corporates have been dominated by this mindset. But the thing is that it has evolved over a period of time, and a couple of things have occurred. One is that there is a notion that executives, and let's just kind of focus on the CEO at this point, need to be incented to create shareholder wealth outcomes or shareholder value outcomes. And the other is a desire to highly leverage the reward outcomes to shareholder value outcomes, because the underlying theory is that if managers, and particularly the CEO, are exposed to shareholder value outcomes, they will then act in the best interest of those shareholders. So that's a simple notion, but unfortunately it became very toxic and corrosive. So let me just quickly lay out how that then played out over time. So reward structures for quite a while were built up into three elements: a base salary, a short-term incentive component, and a long-term incentive component. And the general idea is, and before I get too much further, generally the total target remuneration, or the desired remuneration, is something like a third base, a third STI, and a third LTI. And so 2/3 of the ordinarily expected reward outcomes were categorized as what a lot of people describe as variable remuneration. So the STI component, the short-term incentive component, is built around a series of metrics, in the beginning heavily dominated in sort of short-term financial outcomes, revenue targets, profit targets, market share kind of things, those kinds of things. and other KPIs, but these are all measured over the short term. So one every year, and so a significant component of an executive's reward is tied towards meeting KPIs, short-term KPI outcomes, and a lot of those KPIs are set through top-down aspirational target setting. And what that did is it created the environment for the executives to work incessantly to shoot the lights out to achieve these short-term internal metrics so as they can sort of maximize their reward outcome. Now, over the course of time, became increasingly executive reward consultants and those that are commentators on reward became increasingly cognizant that the scorecard of these STI vesting metrics ought to be lead indicators to shareholder value outcomes. Now, the problem is that the kind of metrics that they're using, did not have a direct relationship to shareholder value outcomes, and B, the targets that they were using, the aspirational targets, the benchmarks that they're trying to encourage boards, executives to hit in order to get 100% of their STI award, encourages this idea of shooting the lights out, which is fundamentally inconsistent with the more in-tuned understanding that more is not always better. And then let's talk about the LTI components. The LTI component was an issue of shares or a grant of shares, and usually it's a fairly large grant of shares, which vest over a period of time based on achieving various shareholder share price outcomes. Now, at one level, this idea might seem, a powerful idea to link or the incentives of managers and shareholders, but the fundamental problem is this. That notion would work reasonably well if capital markets behaved themselves and these vesting metrics were based on wealth creation metrics, not relative TSR metrics. And I'm not going to go into a whole lot of detail about the corrosiveness of vesting outcomes based on relative TSR. I have written endlessly on this topic in the last sort of 5 to 7 years. But I don't even want to encourage that idea anymore, because at the moment, capital markets are so volatile and they really don't operate based on the fundamental economics of the company, that anything that links to a grant of shares based on vesting around metrics that are trying to, reflect top-tier shareholder value outcomes is going to be fundamentally flawed. And so the combination of these STI grants, which, in the early days were cash-based, but increasingly has become share-based, and these LTI grants that are vested on metrics like, relative TSR, have led to a number of interesting things. One is that they have led to remuneration outcomes which are unintended and so high and so disconnected from underlying performance that it has really raised a whole bunch of red flags within the wider community and proxy advisors and various other things. And so there's been this constant chicken and egg rattling around to try and fix a system that everyone knows is fundamentally broken, fundamentally flawed. But all of the fixes have occurred as incremental things, a little tweak here, a little tweak there, but it hasn't addressed the fundamental issue. And so I want to tell a quick story. About a year and a half ago, I was participating in a series of boardroom forums where each event had half a dozen board chairs or um, chairman of the remuneration committee trying to address the remuneration issue. And what struck me is that all of those conversations were basically grounded in the same paradigm that the issue, the problem, was created in the first place. And so here's the first realization. If you want to solve the executive reward problem, and it's important that we do solve that problem, it needs to be solved from a much higher vantage point, and it really needs to be solved from the vantage point of what reward structures do I need to support this ongoing wealth creation in ways that enhance the well-being of the individual, the wider community, and the environment. So it's critically important that the thinking around reward gets basically it needs to start from a clean sheet of paper and this higher vantage point, because any attempt to micro adjust the existing systems and structures, guaranteed it's going to fail. Let me pause the video for a second. I just need to fix up some of the lighting and I'll be back with you in 1 second. Okay, that's a bit better. All right, so I think I just left on the point that if you want to solve the reward problem, you really need to address the issue from a higher vantage point, a clean sheet of paper, and the best vantage point to solve the reward problem is from the vantage point of ongoing wealth creation in ways that enhance the well-being of the individual, the wider community, and in the environment. And so there's a lot in previous podcast series I've put out some fundamental layers of understanding around that. Okay, let me share you one more slide, and I'm going to address the issue of the solution to the reward issue. So here we go. All right. At the end of the day, reward has become so complex and so convoluted, and it's created such a quagmire and such a headache for boards. And I have some sympathy for boards that I have to deal with the reward issue. But look, at the end of the day, there is a very simple solution to the problem, and the solution is almost in no way grounded in current practice. So I think one of the first things we need to do is be willing to let go of current practice. Okay, let's start with the beginning. I think the board needs to, executives and the boards need to begin with this notion that being a leader in the business community, so CEOs and top management team, is an opportunity to be of service to society, not an opportunity to maximize pay through these convoluted and opaque reward systems. I might do another podcast episode on succession planning and executive recruiting, because one of the things on that topic needs to be that if CEOs and senior executives do not have a mindset that their role or their position in this role is an opportunity to be of service to society, then you really need to, I think the board really needs to question whether that individual has the right ingredients to be a successful CEO and senior executives. And one of the issues, and I am sympathetic to boards, is that a lot of the reward conversations are so toxic and so the executives are really fighting the boards to maximize pay and to recommend reward structures that are just fundamentally inconsistent with any of the principles that I'm talking about. It's so I think that the first point is that this whole reward conversation needs to come from a mindset of business leaders serving society. The next thing, which is the second bullet point here, is boards need to clearly articulate upfront the ambition, the expectations, and the outcomes that they require from their C-suite executives over the next, let's call it 5 to 7 years, so their tenure. What is it that the board wants the executive team to do in their tenure? And one of the best ways to articulate those ambitions and outcomes and expectations is in terms of the transformation agenda required to move the needle on the dial on that cause OCI assessment matrix. And of course, the board needs to have a view as to the pathway to that transformation. But my view is that generally the boards are too passive in clearly articulating what it is that they want their executives to do. So I think that's a really important element. The next thing is that the board needs to decide upfront the quantum of total remuneration that they are offering to the CEO, the executive team, for achieving the things that they have clearly articulated in terms of what it is that they want the CEO and the executives to do. And I have here in parentheses any notion that an executive team needs to be incentivized to create wealth, quite frankly, fundamentally, from my perspective, is fundamentally offensive. So the whole premise of the executive reward consulting community, that reward is there to incentivize, retain, and reward shareholder value outcomes, to me is just fundamentally offensive. And the reason why it's fundamentally offensive comes back to the first bullet point, that if an CEO executive team has a view that this role is an opportunity to make a crap load of money, is just wrong. The first thing they need to have is that it's an opportunity to do legacy creating, transforming things to be of service to society. And you don't need to be incentivized to do that, because wealth creation is the job of professional managers. And so you shouldn't need to be incentivizing them to do their job. The incentive for their job is to keep their job, is to recruit them in the first place. And that's why I think I need to do an episode on the recruiting industry. So your incentive is to be recruited and to have the honor to hold this position, and then to hold it over your tenure, because the board always has the opportunity to fire, dismiss an executive, CEO or an executive, if they're not doing what it is that the board expects them to do. I know it's sometimes difficult to hold that fire, but that's, tenure is the incentive, because the job of a professional manager is to create wealth in accordance with the parameters laid out by the board. Okay, so and I don't care so much what the answer to question 3 is. This the quantum question. If the answer is $5 million per annum, over 5 to 7 years to achieve this outcome under tenure, then so be it. If the answer is $20 million, then so be it. But the board needs to decide that quantum question and be comfortable that their decision on that issue will pass muster within the wider community, and so be consistent with community expectations. By all means, engage a remuneration consultant to advise on the quantum question, but any quantum question which is dominated in the idea of being a top tier, top quartile remunerator in a benchmark sense is just it's kind of creating, what do they call those? The spinning wheel that mice run on, right? It kind of just, it spins out of control. So I think the board needs to just think about what it is that they're wanting the executives to do, and think about what an appropriate quantum of remuneration is. Okay. The next thing, if they want to have some of that quantum exposed to share price, then the next thing that they need to decide is what proportion of that total quantum will be paid out in cash versus shares. So let me just pause here for a second. Quite recently, there's been this push to have a very high proportion of total REM exposed to variable REM outcomes and share-based outcomes. I think that's dangerous. I would like to see the proportion of total quantum of remuneration exposed to share price outcomes much lower than current practice, probably less than 30%, maybe 25%. And the reason why I say that is because the capital markets at the moment are so volatile and are behaving in such a disconnected way to fundamentals that if you've got a high proportion of remuneration exposed to share price outcomes, then you will axiomatically have unexpected REM outcomes, either overshooting REM outcomes or undershooting. So either the shareholders will be upset or the executives will be upset. So that's that point. I highly recommend that the proportion of total REM exposed to share price outcomes is much lower than is current practice. The other thing you need to do is to take into consideration that the value of share-based component is expected to increase over time by virtue of the expected wealth creation. And so if you so you just need to understand that. And the expected level of increase in value of those shares is the cost of equity per annum. So if the cost of equity is 5% per annum, then if the cost of equity is 5%, which is quite a low cost of equity right now, then what that means is that the value of that share-based remuneration component is expected to increase by 5% year on year on year. So you need to have in mind this natural expectation of the increase in the value of share-based reward. And a lot of executive reward consultants don't understand this and therefore have a tendency to overpay. All right, the next component is that those share-based awards should be purchased on market, not the issuance of new shares. Because when you issue new shares, you're diluting existing shareholders. So my strong preference is to use cash to buy on market the number of shares required to satisfy this share-based REM outcome. So that's that bit. And then the last bit is to hold those shares in escrow for a long period of time so as to minimize executives seeking to manage short-term share price outcomes and therefore reduce the tendency to add volatility in share prices and capital market outcomes. Now, here's the important thing. Nowhere in this reward structure is there any vesting based on performance. So the only vesting that's going on here is tenure. And so as long as the executive team is doing the job to the satisfaction of the board, then these reward outcomes will be paid. They are guaranteed. And there is a minimum, or there is a moderate exposure to share price outcomes. And so there is no kind of vesting based on performance. It's the award is made, but they're held in escrow, and they're for a sufficient period of time. Those kinds of reward outcomes or reward structures would be consistent with ongoing wealth creation in ways that enhance the well-being of the individual, the wider community, and the environment. It is a simple reward structure, and it is transparent. Everyone knows up front the expected reward outcome, and so on. So yes, there might be some tax implications. You're not going to be maximizing tax outcomes through this structure. But again, any reward practice that puts in place structures designed to minimize the tax implication of the executive reward component, the variable component, again, is just fundamentally, wrong. And so, yes, executives should be paying tax on their awards, and particularly at the point where those shares come out of escrow. So yes, maybe there might be some tax adjustments, but not in a way that fundamentally undermines the reward structure that I've laid out. So thanks for tuning in. I hope this has provided some food for thought. I hope it promotes a watershed of change within the executive reward industry and practice. I know there's a little bit of a tendency towards moving away from metric-based vesting of LTIs, and that's great. But still, there's a lot more work that can be done on reward structures. So I hope this helps. And whatever happens in the reward structure, proxy advisors need to get on board with this kind of thinking. Institutional shareholders need to get on board with this kind of thinking. And boards themselves need to have the fortitude when they put in place reward structures along these lines to push back against proxy advisors and those in shareholders. They may not always be institutional shareholders that are trying to hold them back into the turgent structures of yesteryear, because it's really not helpful. Thanks for tuning in. Look forward to catching you next time, and bye for now.